This is Andrew Stotz of A Stotz Investment Research, and I'm going to talk about my latest academic style research that I call the 10 best days. So first of all, looking at the stock markets over the last year or so, we can see that the headlines get pretty scary. And we can also see that the behavior of investors are driven by fear. And last thing is that we can see that this is a very old article, many years ago, that's showing that this has been around for a long time. So we understand that behavioral economics teaches us that our emotions play a major part in our trading. So one of the things I want to do in this is introduce our academic style research format, and then we'll go through one of our latest papers that we've been working on. So first of all, academic research starts with asking a question. We then move on to summarize previous research to understand what we already know on that subject. And then we formulate a hypothesis to test from that. And then we select a data set, such as the US or emerging markets or whatever, and we clean that data set as minimally as we can, but to remove outliers that don't really represent the data set. And then we apply some methodology to say, here's how we're going to calculate and test this hypothesis. And then we talk about the results. And finally, from a practical perspective, we want to know, how can this help us? What actions can we take from this and learn from it to apply in our investing? So what I'm going to do is talk about the first thing, which is the question that we had, which is what would be the impact of missing the 10 best return days in a 10-year period on the terminal wealth. And this was in the US that we were looking at it. And so if we review the research, here's a paper that was written in 2003, and they looked at US returns over a long and a midterm period of time, and they excluded the 10 best months and found that it reduced terminal wealth by 86%. And they also, concluded that missing the 10 best days reduced terminal wealth by 38%. And avoiding the 10 worst days, where we can see the markets crash quite a bit, increased return by 92%. So trying and failing to time the market is what is most likely to happen to investors, and it's going to hurt massively. Now, if we move on to 2004, we have Johnson and Kruger, who did a study of dollar cost averaging and market timing. And they said missing the 10 best days decreases annual returns by 24%. And if we look at this, if you missed a combination of both the best and the worst days, you'd increase your annual return by 15%. Now, I'm not trying to think about what's a trading strategy that could do this, because I think it would be very hard. But the main thing is that I think it supports the concept that we should be not trading in and out of the market based upon fear. So avoid market timing, and dollar cost averaging can help to just do that. Now, if we look at in 2009, Estrada looked again, and what he found is over the period from 19 to 2006, what did he find? Missing the 10 best days would result in a 65% lower portfolio value, and missing the 10 worst days would result in 206. So higher portfolio. So we can see that the falls in the market are more extreme than the rises. So the odds are stacked against you picking it right, because 10 days out of the period from 1900 to 206 accounted for only about 0.03%. So the concept from this research is telling us to avoid market timing and stick to buy and hold. He continued this research to look at emerging markets and found that missing the 10 best days would result in a 69% lower portfolio value, and missing the 10 worst would result in 337 higher value. And again, this comes back to emerging markets being much more volatile than developed markets or the US. So again, his point was that you only have 10 days out of all of these years is a tiny number, and so therefore the probability that you could pick that is very low. So avoid market timing and stick to buy and hold. Now, in 2007, Faber looked at this and looked at the period of 1928 to 2010. And basically, he saw that extreme days had the same impact. he found that 68% of the best and worst days occur in declining markets, which he defines by being below the 200-day simple moving average. So it suggests that investors can time the market to some extent, but by being out of declining markets. So that's, I think, a sign that if you see momentum turning against the market and against you, that being out of it at that time could be beneficial. So let's go to our hypothesis, and that is missing the 10 best days will significantly lower terminal wealth over a 10-year time horizon. We looked at data for the last 10 years in the US, and we calculated the daily percentage change. We identified the 100 best and 100 worst daily returns, and then we invested in the market but removed 10 randomly selected days out of the 100 days. The point is that a lot of people say, what would happen if you missed the 10 best days? But the probability of you actually being out of the market on the exact 10 worst or best days is highly unlikely. So therefore, we're going to pull them randomly from the 100 best or the 100 worst days. So on those days, we're going to assume 0% return, and we're going to repeat the process 100 times so that we can get some sort of average that can tell us more detail about terminal wealth. And we'll compare it to the outcome of a buy and hold strategy. So let's look at what we're talking about. We take one day randomly selected, let's say that's day 0, and the investor sells his full portfolio position at that time and just before it, and then right after it, they reinvest at the closing price. So they've missed the day. And here is the result of what we found. Basically, the chart on the bottom shows 125, and that's based upon missing the 10 best days. So how can we state this? The text at the bottom of the chart says you start with 100 and finish with 125 instead of 173, losing 66% of your total return because you missed the 10 best days. So we can also see the distribution here, and we can see the frequency in the different ranges. But what we can see is 123 to 125, basically those bars, and 126 and 128, the 3 higher bars are where most of the events happen. So think about our action. Missing only 10 best days during 10 years seriously hurts your terminal wealth. On average, you missed 66% of the gain, but can miss as much as 75%. So stay invested so you don't miss the 10 best days. Come and join us on our website, Become a Better Investor Now. Know it first, learn it first, what we're talking about, get access to additional research and articles, join our free membership and newsletter. So we will see you there.